everybody. Welcome to vis-a-vis. Today we are presenting our third video of the series. The topic is triple top option strategy, close fight versus a Condor. Also, we will be discussing why triple butterfly is a sin. The motivation for this video came from a recent Facebook post wherein one of my known trader had posted that one can take a double butterfly or a triple butterfly in February series, and even most of the hedge funds utilize this strategy. As I have already shown in my second video, which had the topic on double butterfly versus a Condor, that double butterfly is generally not a good idea. So we'll explore triple butterfly today and see that why it's almost never a good idea to trade triple butterfly right at initiation. Okay, so let's go about it. So we are not really ever excited about a triple butterfly. Let's see why. So double butterfly, as shown on the right, is almost always a bad idea. We already explained this in second video, and you must go and look out for this video in our playlist. Double butterfly versus Condor, and how about a Batman strategy? So this is the title of the video. So let me explain a bit here. So this is our at the money strike here, and the strikes are going like this. So in a double butterfly, let's take the extreme case. In extreme case, we create two butterflies, one on below the ATM strike and one above the ATM strike. Okay, and we had shown that this strategy was less performing than Condor. Condor is a superior strategy than this one. The reason being, in the payoff diagram, we could see clear dips, or at least one dip in case of a double butterfly. However, the main reason why Condor was better was that effectively with respect to the maximum profit, if you compare the ratios of maximum profit of a butterfly and a Condor, double butterfly and a Condor, effectively margin utilization was much better in Condor, and therefore improving our return on investment. Now let us suppose if we were to place a three butterfly system, that is triple butterfly, at the initiation step of our option strategy. Let's again take this extreme case in that case. So we will be placing a butterfly at the money, and then the two butterflies will be one below the at the money strike and above the at the money strike. So in our extreme case, we will design our three butterflies in such a manner that the bodies of these butterflies don't overlap, and neither do the strikes overlap. Okay. Now I will not even bother to show you the payoff diagrams for triple butterfly, because if you go and look at our double butterfly, we have very clearly stated that double butterfly is not a good idea and why it is not a good idea. And the same logic will go into this triple butterfly as well. We will have dips, two dips in this case. Okay. Now, what if that dips problem, some manner, some way to tackle that? Yeah, we definitely can do something about it. And that would be if we could overlap the areas or the body of the butterfly. That will do in the next slide. So here we go. So in this case, we can see we are overlapping this, body of the middle butterfly with the other two, or any other combination. The basic idea is the bodies should overlap, and again we will try to keep it as extreme as possible. So we are not going to overlap strikes. So the strikes will be at different points. So basically we will have 3 3 3, that is 9 legs. Okay, and we can have a lot of combinations creating this scenario. Okay, so in this case, somewhat dips problem might be solved, and we will have a larger range, as the proponents of these kind of strategies, propose that we will have a larger range and safe one. So, my point is, a large range or a higher probability of profit need not necessarily be a good trade. For example, you could take 1,000 range Nifty strikes, you could create a strangle with the 1,000 range. Definitely you will have almost 98% or 99% probability of profit. Very, very high probability of profit. But what about the returns? Will be quite less. So absolute returns, return over your investment, and probability of achieving your absolute return or relative returns, the probability behind it. These three are different aspects, and each one of them is important. Okay, so why I took this extreme case where only the body is overlapping but not the strikes is because we wanted to show you a very important concept or a little secret that you'll see in the next slide. So in the next slide, we are going to overlap not only the areas but also the strikes to show you that condor, in fact, any condor can always be constructed as a combination of three flies. So why do we need three flies at the first place? Because as you'll see in the next slide, the minute we create a condor, the legs reduce drastically, and maybe you may get some reduction in margin as well, improving thereby our ROI. So let's look at it. So this is what we have done. We have just shown you a very simple example. Let me just select the pen here. Okay, the pen is already selected. So this is our add the money. So we created one butterfly in this manner. We have sorted two options here, okay, and then hedged the downside and the upside. This is the hedging. So this is our first fly, this is our second fly, and this is our third fly. So our first fly is 1, -2, and 1, and for the second fly, we placed 1 just below this -2, and then this -2, that is shorting two options, and then again buying one option here. And for the third fly, we start from this strike, okay, it's -2, below -2, and this, and then like this. So if we see the net effect, it is 1, -1, -1, and 1. That is nothing but a condor, right? So we have been able to create a condor from 3 butterflies. And this gap between the strikes could be anything. This could be 1 strike on either side, 2 strikes on either side, 3 strikes, or even could be broken wing, maybe 2 strikes here and 1 strike here, or any combination. 3 strikes here, 2 strikes here, 3 strike here, 1 strike here, whatever. And in all these flies. So you can always create a system wherein you will have a condor with a wide range. So instead of taking 3 butterflies, you can always take a condor, right? Because that will have lesser number of legs, right? Okay. Now let's look into another strategy that you might be wondering, when can we really create some complicated strategy that will have a better payoff or better expectations than a condor? Yes, we can. Let's go about it. Let's see that in the next slide. So we have a triple top strategy, and I'm going to compare it with a condor. So Nifty is at 14433.70 on 15th January 21, and so we create a triple top, and this is how we create one. So there are many ways of looking at a triple top strategy. Like just like in butterfly, you can look at it, short straddle, and a long strangle, and so on. So a lot of strategies can be, specifically the symmetrical strategies, can be thought of in terms of combination of straddles and strangles, shorting and long, and so on. So this way you can think of triple top strategy like we have at 14450. That is, we are creating a straddle here, okay, because they're the same strikes, 14450 and 14450. Again, so we are creating a straddle, we are shorting a straddle, then we are long 2 strangles, then again we are short 4 strangles, then again we are short 1 strangle, and then we are long strangle, and then we are finally at very, very far strikes, we are long 3 long strangle. Okay, So strangles all the way, and you know, one straddle here, shorted. So this is how you can create a triple top strategy. You can look at that other way, like we have sorted -1, and then to hedge it, we have gone a bit lower on the put side and bought 2 puts against the sold put, and then again we've gone further down to get some premium. So we have again shorted 4 puts, and then again 1 put, and then we bought 1 put and 3 puts. So this sequence you need to remember, and you can tamper with or play around with some strikes, but they need to be symmetrical on the call side. So this is how you create a triple top strategy. And you can also visualize triple top in terms of like a straddle combined with 2 broken wing butterflies and 2 spreads and so on. So there are a lot of different ways of looking at it. But anyways, so against this triple top, we have tried to create a very similar profile looking Condor, so that the payoff diagram is almost similar. Okay, so this is how it goes. Okay, it's very clear, uh, very easily you can understand what I have done here. So this is, we have created a Condor. So we have in 6 slots sold on the put side and 6 slots bought here, and 6 slots called sold here and 6 slots bought here for hedging. And we exactly have the same pattern on the triple top. We have exactly 6 slots on the call side, and we have exactly 6 put shorts here and 6 put bots, and 6 calls sold here and 6 calls bought here. So just the same number of options we are buying and selling, and the number of puts bought is same as number of puts sold. The number of calls sold is same as the number of calls bought. So that the strategy is completely hedged on either side. So we always play fully hedged strategies. Okay, we don't want to keep any side with unlimited risk. So let's go and look at the payoff diagrams. So as you can see, they almost look similar, but actually when the 2 figures are looking almost similar, we need to look at the scale. The scale for triple top is from -60,000 to 1 lakh, and that for Condor is from -40,000 to 80,000. So the scale for triple top is higher. That means this figure is actually bigger than that of the Condor. So we've got higher profit rate, higher profit size, and the risk is also a bit higher. As you can see here, the maximum loss is around -34, or rather -35 here, and it is only -31 on the Condor side. But if you look at the profit side, it goes right up to 78,000, and while it only goes up to 56,000 or 57,600 or 58,000. But we should not be comparing this purple line, because the purple line here represents just hours before expiry, and you hardly achieve this kind of this is not smooth. So we should be looking for smoother curves, which are easily which we can carry on and achieve. So if you look at this yellow line represents 1 day before expiry. So in our option start proprietary software, this yellow line can be adjusted. You can adjust it to set it to 1 day before expiry, 2 days before expiry, or maybe even today. So T line, that is T is equal to 0. Okay, so you can fix any number of days for expiry. And the other 3 lines, this maroon one and this pink one and this another pink one, these are set at they divide the whole time to expiry into 3 equal parts. So basically this middle line is exactly midway between the expiry. So if the expiry is down 30 days from now, so this will represent 15 days from now, and this will represent around 20 days from now, and this will represent around 8 days now. So 8 days, 15 days, and 22 days, and this again 29 days, and this will be the 30 days. Okay, so just an idea. And so we should be comparing these two with 1 day before expiry and this one, that is 22 days expiry, because normally we the best strategy, or the best as a thumb rule, it's always good to close your condors and butterflies about 1 week to 10 days before expiry. Specifically if you are having long-term butterflies and condors with long time to expiry. So if we compare this one, you can see for the for around this maroon line, it is around 25,000 plus here, between 20,000 and 40,000. So sorry, this will be 32,000. It will be 32,000, and this is 30,000 here, so this will be around maybe 25 or something, right? And this is clearly above 30,000, so this is higher. Let's look at the yellow line. Okay, so these dots are comparable. So this dot corresponds to this dot corresponds to this dot, and this dot corresponds to this dot. So we can just compare them directly. So this how much is it? Oh, it's not clear. It's 38,000 and it's 34,000 here. It's 61,000 here. It's 52,000 here. It's 68,000 here, and it's 56,000. So you see 38,000 versus 34,000, 61,000 versus 52,000, 63,000 versus 56,000, 91,000 at the same strike. So we are comparing strike by strike, and we see that triple top has superior returns compared to Condor here. Also, the range is tad better than Condor, a little better than Condor. Okay, but yeah, the risk is also higher beyond the safe range. The risk is higher in terms, in triple top than a Condor. So in triple top, you will have minus 35,000, and here you have minus 31,000. So let's look at the figure more closely in terms of numbers in the next slide. So here we are. This is our expiry date, 25th of February. This is 24th, one day before expiry, and these are the three intermediate dates. And 15th February is the maroon line. So we'll compare with the maroon line. That is our best comparison. So if we look at the profitable zone, okay, let's compare the profitable zone. We have 211 here, while we have slight negative here, not very high negative, but slight negative, but still this one you can see is clearly in profit here, while Condor is in loss. Triple top is in profit and Condor is in loss. Then you have 12,000, and here you have 9,000. Condor has 9,000. Here you have 22,600, and here you have 18,000. Then you got 29,000 here, and you got 24,000 here. 31,000 versus 26,000, 26, 22, 17, 15, 5,000, 5,000. Okay, so the profit zone definitely is higher, right? Higher, definitely higher in triple top. But the losses are also higher, but the probability of reaching those losses is quite low. So definitely triple top seems to perform much better than Condor here, even on the expiry day, if you see, right? It's quite obvious here. Okay, so better range and higher profits. So does triple top really beat Condor? I would still differ on this. And let me put my perspective very clear why I'm saying so. If you look at it, there are 12 legs in a triple top strategy against 4 legs in a Condor. Now, managing 12 legs is not that easy, specifically when the minimum lot size in a particular leg is just 1. So if you want to adjust your strategy in terms of position size management, as I told you, when you take your positions in tranches, so you'll have to take this whole setup in one tranche, and that may require a bit of capital or at least a lot of trades. And so you take one tranche and then you want to adjust, you want to put another tranche, so, and that too with different strikes. The strikes would have changed because you'd be adjusting because there has been some price movement. Since the price movement has been there, so you will be creating your triple top according to the new strikes as per the change in the price. So it will be quite confusing. Some of the strikes will cancel out and you will end up with a totally new design, right? So it's quite messy, completely. And you have to take all these positions in tranches and adjusting them. So not very easy for a newbie. For a professional, experienced option trader, definitely, since this composes of a lot of internal small trades, a lot of strangles, if you're looking from the point of view straddles and strangle, or from the point of view of straddle and to broken wing butterflies into spreads and some mod options. So it depends on how you visualize it, and based on that, individual entities or individual pieces of this master trade, one can adjust. but that requires a very high level of skill. But if you look at Condor, they're simple, cute, four legs, and Condors are very easily adjusted by shifting the strikes and moving it to the next series and so on. So it's quite easy. Any adjustment will require fewer slippages, fewer brokerage, and so many things. And also this setup for Condor may have some margin advantage as well. Also, and at an advanced level of adjustment or for experienced traders, one of the strategy is to diversify into other segments. What I mean to say is, like, you can take one Condor in Nifty, one Condor you can take in USD INR, and maybe you can take another one in gold if the options are liquid. So since the numbers in Condor are same, 6, minus 6, minus 6, and 6. So you can very easily set up like 1, minus 1, minus 1, 1, and then again you can take 2, minus 2, minus 2, and 2. So you can create very small chunks. So people with even less capital can do this. So if I have lesser capital, then also I can take 1, minus 1, minus 1, 1, and then maybe later I can take 2, minus 2, minus 2, and 2. But with less capital, this kind of tranching is not possible with triple top, because the minimum level is 1. Minimum amount in any leg is 1 lot. So you cannot break this into further smaller tranches. So every time you'll have to like take this heavy tranche, this whole complete tranche you'll have to take in one go. So for large capital people, this is not a big deal, but for smaller people, smaller capital, or at least it will be messy, to say the least, right? Yeah, because might be the margin difference may not be very high. I not checked it, but still it's way complicated. Yeah, and imagine, let's come back to that point again of hedging with another section, another segment. So if I have to take a Condor in USD INR and cross hedge with Condor in Nifty, so I will need only 4 legs in Nifty and 4 legs in USD INR. So that makes it 8 legs. But if you talk about triple top, okay, so I'll have 12 legs in Nifty and 12 legs in USD INR. So that's around 24 legs, and that will just fill up your screen and so much of confusion around. So it's much better, and it's neater, simple, and cuter to trade Condors rather than triple stop, triple top. There are some advantages, but not at the cost of but the trade-off is complexity. So there is a trade-off. Definitely, trade-off is there, and Condors are easily adjustable, so you can later on create a wider range for yourself. It doesn't matter, because ultimately we are trading risk. We trade risks, so I'm really not very fascinated with very wide range or very high pop. No, you have to consider less risk, less profit. And even if you are trading a less pop trade, or if the strategy is simple like Condor, they can easily be adjusted, and effectively you get a wider range. It's always possible to effectively achieve a wider range by way of adjustments, because as we spoke in the second video as well, like when you create a too much complicated system, actually you are doing a lot of adjustments right in the beginning when nothing has happened, no price movement has happened, and you are creating adjustments just before and anticipating this may happen or that may happen. That is playing too defensive, right? So your returns will really not be optimized. Okay, so that's it. Let's just look at the last slide quickly and understand a few pointers. Okay, we already discussed this one. Yeah. So trading with a broader mindset. So keep it simple and systematic. That is what KISS is all about. Also, peace of mind is a consideration. That's very important. Simple trade setups are easier to adjust, at least for a newbie. Now the most important point, no delta risk, no gamma risk, 20% wild swings, resilient, that is resilient to 20% wild swings, no downside risk, etc. There is absolutely nothing glamorous about it. Those who trade such super safe strategies also trade higher risk and stressful strategies, for example, bank nifty expiry trades, to increase their performance report in terms of ROI. For any strategy, long-term success needs to be verified. Most of the advanced strategies on the internet were designed out of marketing needs, maybe because they want to advertise for their training programs. So they need to create something fanciful. Rarely an expert will reveal his strategy online for free. What kind of strategies? Long-term, successful, super safe strategies. Yes, there do exist super safe strategies that are successful in the long term. But you really believe any trainer is going to train you strategies that are super safe and they are super successful in the long run and they can give you, 100% to 200% return per annum? Are they going to teach you for 30,000 rupees for 2 days? No, they're not going to teach you because the potential returns are way much higher, right? So you should be willing to learn. At InvestBiz, we are here. We are presenting a lot of videos on the YouTube so that you can learn the best concepts here. We can clear all your doubts. You can raise your queries in the comments. We will show you the path how to design some advanced strategies and grow your trading skills. Now, we trade risk for potential earning. Take calculated risks in trades and balance your life well. This is our basic thumb rule. We always maintain a healthy balance. Trading is not life. Superior returns are possible through simple trade setups as well. So keep your mind cool, study and work hard. Don't go after too many fancy strategies. We will keep on making such videos where we will show you how simple strategies like simple condors or butterfly or even spreads can give you decent 30 to 50% return consistently every year. And then we'll move on to advanced strategies wherein we will be talking about calendars and even we can move up to when trade setups where you will be trading 3 or 4 series, 3 or 4 series. That level of complexity we'll talk about. But you have to go step by step. Start with the basic, target 30 to 40% first, then target 100%. It's just like when you write a competitive exam, say if 100 score gives you a 99 percentile, so you should not target 100 right in the beginning. First, you should be consistent with scoring 80 percentiles, so maybe around 70 marks. Then you should slowly push yourself to 90 percentile, maybe around 80 marks, and then slowly and finally you should, you know, till you achieve consistency at one particular level, maybe around 50% returns, you should not move to the next, right? Go step by step, slowly. Do like our videos if you really got some inspiration or you learned something useful from our videos. Subscribe to our channel for our updates. We'll be posting a lot of videos not only related to option setup but also stock market predictions based on machine learning tools and how we designed adaptive indicators, adaptive strategies based on machine learning. They self-learn based on the events or the past data. They're consistently evolving themselves. It's kind of you can say not really artificial intelligence but purely machine learning concepts from data we've taken from data science and all. So we'll be posting them and hopefully you'll find them interesting. Stay tuned. Thank you.